Most people think dividend investing means buying high-yield stocks and collecting checks. That's only half the strategy. The other half is growth. And when you combine yield with growth, something magical happens to your income over time. Let me explain what dividend growth investing actually means. You're not just looking for companies that pay dividends right now. You're looking for companies that raise their dividends every single year after year, like clockwork. These are businesses that consistently increase how much they pay shareholders, and that changes everything about your retirement math. Here's why this matters more than most people realize. Inflation eats away at fixed income over time. If you retire on a fixed pension or annuity, your purchasing power shrinks every single year. What buys groceries today won't buy the same groceries in 10 years. But dividend growth investing solves that problem automatically. Your income rises to match or beat inflation without you doing anything. The companies handle it for you. They grow their profits, they raise their dividends, your income goes up. Now here's where it gets interesting. Most investors focus on yield when they're starting out. They see a high-yield stock paying 8 or 9% and they think that's the best option. Makes sense on the surface. But here's what they're missing. High yield today often means low or zero growth tomorrow. The highest-yielding investments rarely raise their dividends significantly. They're already paying out most of what they make. Dividend growth investors think differently. They're willing to accept a lower starting yield if the growth rate is strong. Maybe you start with a 4% yield instead of 8. Feels like you're leaving money on the table initially. But watch what happens over time. That 4% yield grows 5 to 7% annually, while the high-yield position stays flat. Drop a comment if you've ever chased high yield only to realize it wasn't growing. I want to know how common this mistake actually is. Let me give you a concrete example of how this plays out. Imagine you invest $10,000 into two different approaches. Option 1 is a high-yield fund paying 8%. You get $800 the first year. Option 2 is a dividend growth fund paying 4% with 7% annual dividend growth. You get $400 the first year. First year, high yield wins by double. Feels like the obvious better choice. But fast forward 10 years. The high yield position still pays you $800 annually because it never grew. The dividend growth position now pays you almost $800 too. And it's still growing 7% per year. By year 15, the dividend growth position is paying you significantly more than the high yield position ever did. And the gap keeps widening every single year after that. That's the power of compounding dividend growth. It doesn't look impressive at first, but time makes it dominant. Now here's the part that really matters for early retirement. Your yield on cost keeps rising with dividend growth investing. Yield on cost means what percentage return you're getting based on what you originally paid, not what the stock's worth now, what you paid back then. If you're getting value here, smash that subscribe button. I'm posting dividend strategy content every week that nobody else is talking about. This is how you actually retire early, not the fantasy stuff. Let me show you how yield on cost changes your entire perspective. You buy shares today at a 4% yield. Company raises dividends 7% annually for 10 years straight. Your yield on cost is now almost 8%. But here's the crazy part. You're getting that 8% return on your original investment amount, and the shares are probably worth way more now too. So you've got income growth plus price appreciation. Double compounding working in your favor simultaneously. Quick disclaimer, I'm not a financial advisor and this is educational purposes only. I'm not selling courses on how to get rich. I'm just someone who figured this out early and feels obligated to share it. Everything here is my own journey. Your situation is different. Your risk tolerance is different. Your timeline is different. Do your own research, but at least understand what's possible. Because most people don't even know this path exists. Here's what separates dividend growth investing from speculation. You're investing in actual business quality, not just yield numbers. Companies that can raise dividends every year for decades are fundamentally strong businesses. They have pricing power, competitive advantages, growing profits. Weak companies can't sustain dividend growth. They get exposed during recessions and cut their payouts. So when you filter for consistent dividend growth, you're automatically filtering for business quality. It's like a quality screen built right into your strategy. The dividend aristocrats are companies that have raised dividends for 25 consecutive years or more. Think about what that means. They survived multiple recessions, market crashes, economic cycles, and they still raised their dividend every single year. That's not luck. That's business model strength showing up in real cash payments to shareholders. Now, let me tell you what this means for your freedom date. Most retirement calculators assume you need to save a massive amount. They tell you to save for 30 or 40 years, accumulate a huge nest egg, then withdraw 4% annually in retirement. That's the standard advice. But dividend growth investing flips that model completely. You're building rising income from day one. You don't wait until retirement to start benefiting. You're collecting and reinvesting dividends the entire time you're building the portfolio. And by the time you're ready to retire, your yield on cost might be double or triple what you started with. Same shares, way more income. That means you need less total capital to hit your freedom number. Maybe you can retire on half of what traditional planning says you need. Because your income's still growing after you stop working. It's not a fixed 4% withdrawal, it's a rising dividend stream. Here's the psychological benefit nobody talks about. Dividend growth gives you something to look forward to every quarter. Most investors have nothing to celebrate except price going up. And price is random and unpredictable. But with dividend growth investing, you get announcement dates. Companies announce their dividend increases on a schedule. You literally know when good news is coming. It's like having multiple paydays throughout the year that keep getting bigger. That positive reinforcement keeps you engaged and excited about your portfolio instead of anxious and stressed. Big difference in quality of life. Let me address the biggest objection I hear. Some people say dividend growth is too slow. They want faster wealth building. Here's my response. Slow and steady actually gets you there faster than fast and chaotic. Growth stock investors make money sometimes and lose it other times. Their equity curve looks like a roller coaster. Dividend growth investors make steady progress that compounds predictably. Their equity curve looks like a staircase going up. Over a decade or two, the staircase beats the roller coaster almost every time, because you're not giving back your gains during the inevitable crashes. Your income kept growing right through the downturn. That's the real edge. Now here's how to think about allocation if you're building this strategy. You want a mix of current yield and growth potential. Pure growth with low yield takes too long to generate meaningful income. Pure high yield with no growth loses to inflation. The sweet spot is somewhere in the middle. Moderate starting yield with consistent growth rates. That gives you enough income today to stay motivated, plus enough growth to reach your goals faster than traditional investing. Think about what you're actually optimizing for. If you want maximum income right this second, go high yield. If you want maximum income 10 years from now, go dividend growth. If you want both, build a blend. Most people in the accumulation phase should lean toward growth. You're reinvesting everything anyway, so starting yield matters less. Drop a comment and tell me which approach fits your situation better. Are you optimizing for income now or income later? Here's what I'm doing personally. I'm focused on dividend growth during my accumulation years. I want my yield on cost climbing every year, so that when I hit my freedom date, I'm generating way more income than if I'd chased high yield from the start. That's the long game. If you want to see the complete breakdown of how to structure a dividend growth portfolio, check the playlist in the description. I cover fund selection, allocation strategy, rebalancing rules, everything. And make sure you grab the free lead magnet about the 7 retirement myths. It'll show you exactly why the traditional 40-year plan is broken and what to do instead. Join the community, watch the next video on dividend snowball strategy, and I'll see you there.